Welcome to this week's Market Matters weekly update. Today I'm joined by Peter O'Connor, Shaw and Partners resource analyst. We're going to talk all things coal and iron ore, the two sticky commodities at the moment, the two commodities that are under the pump. I'm going to start with coal. Coal prices, Peter, have been hit really strongly. They were trading well north of 200. They've traded back sort of around that 130 at the moment. What's your take on the dynamics of the coal space at the moment? Should we be concerned? Is the trade dead, or has it still got life left in it?
Firstly, good to be back, James. And look, coal in the last week has been extraordinary. So, firstly, the energy thematic, including coal, continues, but there's certainly been an inflection point in terms of what China has done the last week. What has happened? We'd seen for a period of about a month prior to last week, China trying to jawbone prices lower for thermal coal used for power generation. That wasn't really happening. Mid last week, they took it a step further. They started re-implementing production that had been banned the prior month for safety reasons or environmental reasons. That kick-started a flow of supply, which has got the market less concerned in China about supply going to the next couple of months. That said, it's early days yet. We're not even in winter. China's already bracing for a cold winter. We've got Europe short of gas and turning to coal. We've got the US short on, high-priced gas, they're turning to coal. We've got the Japanese saying the same thing, they're turning to coal over the northern winter. So we've got three of the major geographical and economic blocks looking to turn more to coal over the next few months. So that energy thematic, which has been a key driver of our view over the last 12, 15 months, which is partly a COVID recovery plan, but more recently it's about just relative pricing, and gas price has really stretched. So coal looked attractive still a week ago at $200. It now looks even more attractive. So price actually bottomed or found a floor yesterday. So you mentioned 135. It's back at about 155. So,
futures rallied 15% yesterday.
It feels like we're going to create a level now which is more reflective of what's happening. But I think we've printed the high for a coal price, which is in the 250 range. And now we need to see the market rebalance, but there's still a demand story.
That's huge volatility. Normally you have China come into a market and there's a lot of rhetoric, and it has some short-term impacts around price, but ultimately supply and demand dynamics dictate prices in the medium term. Is it a surprise at how much impact they actually had over that time period, or is it a lesson not to fight the PBOC?
Well, again, so they started by jawboning or articulating a view to lower price. That didn't work, and it didn't work in iron ore over the course of the last year either. What's changed is the September safety inspections, which they put in place to try and improve the safety of their mines. They've just unwound, or started to unwind the last week or so. The key number to think about is the Chinese would like to produce and deliver to power stations about 12 million tonnes of coal per day. That's a lot of coal over the course of a year. And they were doing down as low as about 10.8 million tonnes per day. Doesn't sound a lot, but when you're talking about over the next 90 days, that could be 55, 60 million more tonnes of coal. So just by moving that dial, by starting some mines that have been shut for safety reasons or for environmental reasons, that's given the market that view on supply and demand. So they've moved the dial on that fairly quickly. So is that sustainable? Probably not, particularly going into the winter. And we've also got the Beijing Olympics in February. And that's an issue about air quality, and burning coal doesn't help the air quality. So I don't think this story is fully played out yet in terms of, we've seen our high, but I still think price will stay higher. But the shock in terms of what they did, we shouldn't be surprised by the PBOC or the Chinese government, what they can do, but the dial this time was, in iron ore they didn't have that lever. This time in thermal coal they do.
All right, so obviously the coal stocks, Whitehaven Coal, we've got across our portfolios, Coronado's in our portfolios as well. They've had a phenomenal last 12 months. They've been under pressure in the short term. So that you're staying positive on those two names.
Yeah, given they've already retreated and given back some of that price retreat, I think that's now largely priced in. So I'm watching very closely in the next few days and week just to see how we stabilise. But again, just the way I'm thinking about it is we've got northern winter, which we still haven't entered yet. The Chinese government actually said the other day for their house owners to go and stock up ahead of what could be a cold winter.
I read about that,
They're planning for that. And again, gas prices stay high, and that relativity in the energy complex is such that prices don't move too far apart from the general trend. So coal prices are now very cheap relative to gas. So I think you get a pickup in gas use in Europe, in US, other Asia. You get China colder winter, or more broadly, and so the price should find floor, and we should perhaps even see a little bit of an uptick. So
okay. So
Still remaining happy to stay there for now. Yes.
Exactly right. Let's move on to iron ore. This is your cautious iron ore 200. It's come back now and it's trading below $100 a ton. That $90-$95 is you see some supply coming out of the market. What's your take now? We at a short-term low, and I guess for the next 6 months, how do the supply dynamics stack up in iron ore?
So we've found a new price for the next 3 months, 6 months. So $100, call it that, 90 to 100. That's where you start to get pain. And what do I mean by that? I mean supply, as you said, starting to drop out of the market. So in the space of 1 week, in mid-September this year, we saw 3 Australian producers announce they were curtailing capacity because they were struggling to make a margin. And even Fortescue today, they're making a margin of about $100 to $110 per tonne just 3 months ago. That's now down to $10 per tonne. Still a lot of money they're making net cash, but not as much as they were. And people like Mineral Resources, who are more marginal than Fortescue, probably getting pretty close to not making money.
Yeah.
So that's telling you that the curve's probably come down in terms of price as far as it will for now. I stress for now. We still see price lower in the next 1, 2, 3 years, but 3 month, 6 month view, probably $90 will be our low, and it'll trade between about 90 to about 110, 120.
So what I'm getting is both of the outlook here around coal, around iron ore. They've obviously been whacked in recent times. They're nearer a low point in the range than a high point in the range. That's true for the stocks that are exposed to them. Fortescue, Rio, BHP to a lesser extent, but still very important. So where you're remaining cautious on the iron ore space more than the coal space, or how do you marry up the two?
I see iron ore as a trade at the moment, so it's found a floor. It's going to trade off that floor and be volatile, but we're at the low end of that trading range. So like we saw it from September through to October, we saw quite a strong rally in iron ore and iron ore equities. So we'll see that again. So I think it's down, not a one-way strategic or structural view. It's about trading, and that's much more shorter term. So month to month, quarter to quarter. But I see that being that way for at least the next 1 or 2 quarters.
Peter, thanks for joining us.
Thank you, Jim.